Okay. It looks like we are at the top of the hour here. I guess I should say the bottom of the hour. Good afternoon to everybody on the East Coast and good morning to everybody that's on the West Coast. Looks like we still have a few people trickling in, so I'll give it another 5 or 10 seconds and then we'll go ahead and kick the presentation off. Okay, so I still see some people coming in. So well, in the interest of time, we'll go ahead and get started. First and foremost, thank you for taking the time today to join us. Time is your most valuable asset, so we truly appreciate you spending some time with us this afternoon. My name is Chris Reese. I'm the founder and CEO of MJ REIT. And on behalf of myself and everybody at the organization, thanks for spending some time with us today. Just a little bit of background on me before I get into the presentation. I've been in the asset management space for almost 30 years now. Half of those, or 15 years, were spent on the public side. And then about 14 years ago, I transitioned to the private markets. And in doing so on the public side, and I'm a big believer of having exposure to both public stocks and bonds, what I noticed was there were periods of time where I saw enhanced volatility within the public markets. So I knew there had to be a better way to dampen that volatility, increase diversification, and potentially earn some additional return above and beyond what you can get in the public markets. So I transitioned to the private markets 14 years ago, and ultimately in late 2022, identified a unique asset in a specific industry where we launched MJ REIT to take advantage of. And we're going to spend some time today going through that industry. We'll talk a little bit more about MJ REIT and some of the potential benefits that we can bring to your overall investment portfolio. And so before I begin, I just want to hit a quick disclaimer. This presentation is not an offer or an opportunity to buy. That offer is only made through the PPM, a consultative financial advisor, before investing. And of course, past performance is not a guarantee of future results. So I figured I would start with just an overview very briefly on who we are. And we are, at our heart, an institutional real estate lender managing a debt fund. And we're providing capital to an otherwise capital-starved industry. And we're doing it in an investor-friendly focus. So the fund has monthly purchases, monthly redemptions, monthly distributions, monthly valuations, and it is 1099 tax reporting. Interestingly, from our inception, we've been able to generate an annualized return of 11.33%. And that is net of fees and expenses. But keep in mind, and I'll come back to this when we get into a little bit of the dynamics within the cannabis space, in particular in the real estate cannabis space, we don't touch the plant. We simply finance a piece of commercial real estate and underwrite that using an alternative asset valuation. And in the mortgages that we underwrite, we keep the maturity very short. So think of 2 to 4 years. And then we'll lend up to 75% LTV on that non-cannabis valuation. Now, this will all make sense as we go through the presentation. So for those that are just hearing this for the first time, we're really going to spend some time this afternoon really kicking in and understanding the dynamics of the real estate space within the cannabis markets. So I have 4 basic objectives today. The first, and this might be a little bit basic for many of you on the phone, which is why even consider alternative investments in the first place. And then we'll transition and look at how private real estate can help diversify your portfolio. We'll transition at that point to real estate within the cannabis sector. And specifically, we'll end with how MJ REIT may make sense for your overall broadly diversified portfolio. So on the alternative asset side, I'm always taken back by some of these statistics. And if you were to look at all of the companies in the United States, the vast majority of those companies are private versus public. In fact, all companies, if you look at the number, is north of 96%. If you look specifically, and the chart on the left-hand side shows this, if you look at the larger companies, and I defined large as those with annual revenue of in excess of 100 million, 86% of those companies are private, while only 14% of those are public. So said differently, if you have exposure only to the public area of the US economy, you're missing 86% of the potential opportunity. And often when I cite numbers like this, people look at me and say, I hear you on that, but what about the mega caps? You think about these huge companies that generate billions of dollars in revenue. And so in the chart on the right-hand side towards the bottom, I show the percent of public versus private to companies in the US that generate annual revenues in excess of $1 billion. And even these huge or large corporations, 11% of those are private, while 7% are public. And so even in the big cap companies, most of those companies are private versus public. So the opportunity here really is to begin to allocate or consider allocating to private assets as opposed to public assets. And why would you do this? Really, three main reasons. The first is to enhance diversification within your portfolio. Second is to dampen the volatility. And third is to increase the potential of outsized returns. And think about the volatility that we've seen over the past 3 weeks, 4 weeks. We've seen excess volatility within both the public stock and public bond markets. But if you look at what we've done on the private side, and specifically what MJ Reed has done for the first quarter, we've really seen no volatility. So in an otherwise volatile market, MJ Reed has provided stability, it has provided diversification, and we've been able to outperform the public, both stock and bond markets. I wanted to show a quick graph on the allocation amongst Tiger 21 members. And for those that aren't familiar with Tiger 21 is a group of ultra wealthy individuals. The minimum net worth to get into this group is, I think it's 25 million, may even be 50 million today. But what's striking to me is if you look at the allocation of their members, and this is as of the fourth quarter of last year, only 23% is in the public stock market and 7% in the public fixed income market. Said differently, this group has only 30% of their overall investment portfolio allocated to public stock and bonds. Alternatively, if you look at their exposure to alternative investments, and that would comprise private real estate, private equity, hedge funds, commodities, currencies, that's north of 60%. And not saying it's right or wrong, but it's interesting to take a look at how the ultra wealthy are allocating their portfolio, and maybe we can learn a lesson or two from that. So what is the opportunity in real estate and specifically within private real estate? So taking a step back, real estate is the third largest asset class in the country, behind fixed income and stocks. So stocks with a total market cap of just under $50 trillion, US debt outstanding approaching $55 trillion, and real estate on the commercial side, just about $25 trillion. So it's very large, but unlike fixed income and stocks, within real estate, you can actually get the best of both worlds, meaning that you get the income associated with rents and you get the growth orientation associated with the property price increases. So you get the best of both the fixed income world and the equity markets, but it's combined in one overall asset class, which, by the way, again, is an enormous asset class. And similar to what I looked at earlier with the private versus public companies, the main way investors get exposure to the real estate market is really through private investments. So think about buying an individual townhome or renting it out yourself versus buying a public REIT. So out of all the exposure within the commercial real estate market, 94% of that is public and only 6% is held by publicly traded REITs. And if you look at how institutional investors typically allocate, which I show on the right-hand side of the slide, 12% of those, or I should say within the pension plans, they have an allocation of about 12% to commercial real estate, 10% within the endowment and foundation world. But if you look at the average investor, less than 3% have exposure to private real estate. So the opportunity today is really to take a better or deeper dive into the commercial real estate on the private side and begin to consider allocating this within one's portfolio. One of the big benefits of an allocation to private commercial real estate is that real estate has tended to outpace inflation. And we've heard a lot over the last couple of years about the Fed's fight with inflation and trying to get inflation down to their target. On the real estate side, real estate has tended to outpace inflation as rents tend to increase faster than overall inflation. So an allocation to private real estate has the potential to hedge against inflation. And in addition, it has the ability to provide consistent income. So what I'm showing on this screen is the annual income over the last 20 years. Now, keep in mind, this is a diversified real estate bucket and not necessarily a specialty real estate, which we'll talk about in a few moments. If you look over the last 20 years, 16 of those years had income in excess of 4%. 4 of the years had income annualized between 3 and 4%. But interestingly, 0 had income less than 3%. And so the consistency is here. And again, when we look at specialty real estate, we're going to see these numbers even higher and even more attractive. So what is the opportunity as we see it in specialty real estate? And I throw this term of specialty real estate out because it is a broad area of the overall real estate market. And it can really mean a number of different verticals within the real estate space: agricultural, recreational, historical buildings, even movie theaters. And I've highlighted in green on the top left, where we'll spend the vast majority of this presentation and our time today focused on cannabis real estate. And it is a unique area, and we're going to talk a lot about the uniqueness and how MJ REIT is poised to take advantage of the opportunity within the cannabis real estate sector. So when I think about the cannabis market dynamics, and this is one of the important slides, and I have some corresponding slides that will highlight each one of these components, but cannabis tends to be one of the fastest growing areas of the U.S. economy. It's got strong growth, but it's doing so with a lack of traditional financing. Because cannabis is illegal at the federal level, you can't go to Wells Fargo or JP Morgan for a mortgage on a property. So you have strong growth, you have lack of traditional financing, and then lastly, you have limited institutional involvement. Now, that institutional involvement will come at some point in the future, and with that, a wave of capital essentially propelling all assets higher. Now, when that comes, whether it's 3 months or 3 years or 6 years from now, but when it comes, it will provide and propel assets higher. So looking at the strong growth characteristics, and this is an important slide. So what I've shown here is the migration of states as they begin to launch either medical or recreational/adult use programs. So going back in your minds, it all began in 1996 with Proposition 215 in California, where California legalized medical marijuana. Roll forward 4 years, and the chart on the left-hand side, what you'll see is that 4 years later, you had the entire West Coast have at least a medical program. 10 years on, which is in the middle, more and more states coming online, and even some East Coast states, and then roll forward through today. And what you'll notice is something where the vast majority of the country has at least a medical program. In fact, 41 states, DC, and a few US territories have at least a medical program. And we expect this to continue over the coming quarters, months, and years. Interestingly, because cannabis is still illegal on the federal level, you can't cross state lines with cannabis, meaning that when the state of California starts a program, that state needs to have real estate to not only grow and process, but also to sell that cannabis. And that creates a barrier to entry because you can't have Philip Morris come in and grow 5 million acres of cannabis and transport it across all of the country and drive down prices. So you have barriers to entry. And you think about why these states are actually rolling out these programs. If you're the governor of the state of Arizona, if you raise taxes, most likely you're going to lose your job. But if you institute a program whereby you can start a medical cannabis program and tax that and generate tax revenue to fund schools, roads, social programs, that's a good thing for the overall state. And in fact, since the start of cannabis on the medical side, the states have collectively generated more than $22 billion in tax revenue to be used for all of these different services. So we don't believe that this is going away. It's here to stay. And if anything, we're going to continue to see this migration over time. From a growth characteristics or a continued impact standpoint, sales in 2024 were just about $32 billion. And we forecast that continuing to increase over time. But what's interesting is that if you take the additional economic impact, that is when somebody within the cannabis space gets a paycheck and they spend that paycheck on rent, groceries, etc., the economic impact of that is far greater. So last year estimated at over $100 billion. And then by the year 2030, that additional economic impact increasing to over $200 billion. And as more states come online, we should expect to see these numbers grow. With the next big state here where I am in the Commonwealth of Pennsylvania, Governor Shapiro for the last few years has tried to get recreational cannabis on the ballot and pass, because if you live in the state of Pennsylvania, 5 of the 6 bordering states have a recreational program. So if I'm in Philadelphia, I can very easily go over to the state of New Jersey and purchase recreational cannabis. And guess who gets the tax revenue from that? It's not Pennsylvania, it's New Jersey. So we expect more and more states to come online. and continue to have the economic impact specific for cannabis continue to have a bigger part of the U.S. economy. From a banking standpoint, and this really hits on 2 points. First is the lack of traditional access to capital, and then secondly, the average or the institutional ownership. So on the left-hand side, I look at the banks in the United States. So in the U.S., we have just over 4,500 banks. Out of those, at last check, we had about 560 that would accept deposits from a cannabis operator. But keep in mind, when you are a cannabis operator and you're depositing your cash into a bank, sometimes these banks actually charge you. So it's a negative interest rate, given the additional compliance hurdle that these banks need to have. But banks making loans directly to cannabis companies tend to be very low. In fact, by our last count, we were less than 50 banks that were actively providing mortgages or loans to cannabis companies. And therein lies the opportunity as we see it. This will change eventually, but for the next, we look at 5 to 7 years, given the current administration, we're probably not going to see a big change in the number of banks making any types of loans to cannabis companies. And on the institutional side, I've looked at the percent of institutional exposure to the top 5 alcohol and tobacco stocks versus the top 5, what we call MSOs or multi-state operators. So the average institutional ownership of the top 5 alcohol and tobacco stocks is approaching 80%. But if you look at the top 5 cannabis MSOs, that's about 7% overall. So we're not really seeing that institutional ownership as of yet. But as I mentioned, at some point that will change and bring about a flow of capital that should propel all assets within the space higher. And then from additional tailwinds, and this is a little bit dated because had we had this call been 6 months ago, we were very optimistic that cannabis would be rescheduled from a Schedule 1 to a Schedule 3. For those that don't follow the markets as closely, under the Biden administration, Biden essentially made a recommendation to the Department of Health and Human Services to evaluate cannabis for medical benefits. They came back and said, yes, there are indeed medical benefits, and made a recommendation to the DEA, who actually has oversight on what drugs are on the controlled substance list, and recommended that cannabis be removed from a Schedule 1 and made a Schedule 3 controlled substance. That would bring about a bunch of additional benefits to the industry. But since that time, it's continued to be marred in additional legal battles. And as of today, there's no future date yet for the DEA to actually move forward with this. And given what's going on in Washington, we do expect at some point in the future that this will resurface. But right now, there's no definitive date for any additional movement for cannabis to be rescheduled. Another benefit would be some sort of memo from Attorney General Bondi that would outline the aspect of medical and the treatment of individual companies within legal states trafficking in illegal substance. The next is the state legalization. I mentioned earlier that 41 states, DC, and a few U.S. territories have at least a medical program. We would continue and expect to continue to see this increase over the coming months and years. And really, if you look at the vast majority of Americans believe that cannabis should be legal for at least medical and or recreational purposes. And lastly, because cannabis is a Schedule 1 narcotic, for the most part, companies are restricted from listing on exchanges. But if you look at, you might pull up some of your brokerage accounts, you could go in and buy Tilray or Canopy Growth or one of the other publicly traded stocks. Those stocks are traded on the Canadian exchange. The Canadian exchange has a lot less liquidity and limited institutional involvement. So should companies be able to list on the U.S. exchanges, that would provide a deeper liquidity pool and access to additional institutional players. So that would additionally be a tailwind for the market. So as we look at the background and the market overall, how do we capture this opportunity? So I won't go through this. I mentioned just very briefly the strategy statement and the investor value proposition. At our heart, we're originating transactions to finance cannabis real estate. The vast majority of the portfolio is designed to invest in mortgages. We do have the flexibility. If we see an attractive sale leaseback transaction, we can underwrite or originate that. And then from a value proposition, it's really to provide stability of principal for our investors and above market monthly income. So with MJ REIT, you get the best of both worlds because not only are we focused on originating these particular deals on both senior mortgages and sale-leaseback transactions on the private side, but we also have the ability, should the market correct, to take an opportunity into public securities as well. Right now, we have about 7% of the portfolio in cash as we're beginning to build a cash position, as we have a few transactions that should close over the next 30 to 45 days. So we're building a little bit of cash, and that's just kept in a money market, earning at least some income while we're waiting to deploy that capital. But with MJ REIT, you get not only the income and stability, but you get the enhanced diversification, and we'll talk about that in just a moment. The goal of MJ REIT on the total return side is we focus on a 10% annualized distribution that's paid monthly. So on the big chart on the bottom, I've highlighted our monthly distributions, and they've ranged anywhere from just about 10.2% to as high as 16.67%. And every month over the last 31 months, we've exceeded our 10% target. But because we're taxed as a REIT, there's an additional benefit our investors receive in that you're only paying taxes on 80% of the distributions. So you get a 20% tax deduction that further would enhance your taxable equivalent yield. So I show that on the left-hand side, and if we assume I paid a 10% distribution and only 80% of that distribution is taxed on the federal level, that would take your taxable equivalent yield to 11.2%. When you look at the chart, you do see a couple of those big numbers for March of 24, May of 24, and then October of 24. We have, and because we're taxed as a REIT, and I'll talk a little bit more about this when we look at the specific deals, when we have a property that pays off, any additional income that's generated from that, we pass on to our investors. And we had a property that sold in those 3 months, and as a result, we passed that additional income, so our investors earned a very attractive monthly distribution during those 3 months. Had you invested in day one into MJ REIT, your $100,000 investment would be almost $132,000, so a cumulative return of about 32%. That breaks down to an 11.33% annualized return net of fees and expenses, with our March distribution that we paid earlier this week coming in at 11.00%. And importantly, when we make these distributions, 100% of the distribution that we pay to our investors is from the interest that we're generating or rent that we receive off of the originated transactions. So we're not over distributing or providing a return of capital so that we can appear to be paying more. I want it to be clear that all that distribution that we've paid is from interest or rent that we've earned off of our investments. And I don't want to get too confusing here, but right now, MJ REIT is the fund overall. We have a sub-manager that's in market every day finding deals to diligence. And that sub-manager is a group called Rainbow Realty Group. Rainbow is a part of the Gould Investors, which is about a $3 billion New York family that's been in real estate for over 63 years, thematically investing. So think about garden-style apartments, parking garages, movie theaters in the 80s. And they identified cannabis as an opportunity in 2014, where they financed the first license for the state of New Jersey. And they quickly realized that this is a unique asset class. And if you were to analyze this piece of commercial real estate as a standard piece of real estate, as opposed to providing some additional enhancements because of the cannabis overlay, you can really earn an outsized return or better risk-adjusted returns for investors. And our investment committee, very proud of the members on this committee, have collectively over 200 years of real estate experience, whether that be in deal structure, legal accounting, finance, all focused on the real estate area. So 200 plus years, very seasoned. And in order for a deal to get into the portfolio, it needs to pass this investment committee. And we're very selective at the deals that we finance. Out of every 100 deals that we evaluate, we'll close anywhere between 1 to 2 of those deals. And given the market overall, and it should probably come as no surprise, given the high growth with lack of access to traditional financing, we can be very selective in those deals. We're in no hurry to deploy capital. We're only in a hurry to deploy capital to quality deals at low LTVs. And we'll talk a little bit more about that in just a second. From a deal sourcing standpoint, we really have, being one of the few lenders still in the space, we have a very broad number of ways that deals come to us. So first and foremost, we have a network of brokers. We have other lenders in the market. We have repeat borrowers. We have relationships with lawyers, accountants, company consultants, and general marketing and brand of Rainbow Realty Group. And this is a flow of a deal as it finds its way from start to potential close. But know that along the way, most deals that enter this funnel get kicked out for one reason or another before they actually get closed. So it's really meant to show the overall process, but just know that the vast majority of deals that enter get kicked out. And probably the most important slide when you think about what we do at NJ REIT is this particular slide. So let's just say, as an example, that all of us on the phone, we get together and we are awarded a license to cultivate cannabis in the state of California. We go out and we identify a piece of industrial real estate, warehouse, and we buy that real estate and that warehouse for $2 million. In order for us to grow cannabis, we may need to put $6 million of improvements into that building. So think of advanced security or enhanced irrigation, lighting, HVAC, enhanced power. So when you think about the opportunity for us, that building now is $8 million, $2 million that we bought it for, and the $6 million of improvements. And it would be to a cannabis operator, but critical, and this is very important, critical to every deal that we get into, I assume cannabis goes away. And so if you're a standard industrial tenant and you need to lease an industrial warehouse, do you want to pay an extra $6 million for 14 air conditioners and state-of-the-art security? Probably not. And so the point is that we don't give the borrower the bump in valuation associated with the improvements. So in this deal, instead of coming in at an $8 million valuation and underwriting a senior mortgage at 75% of $8 million, we're going to come into this situation and say, okay, the next non-cannabis tenant is going to probably value this at $2 or $2.25 million. So we come in and put that valuation low, and then we'll lend up to 75% LTV on that lower valuation. And that is the most important aspect that keeps us out of deals that have tended to explode or have defaulted in the past, which today we've had 0 defaults in the fund. Since we launched, we have been successful in a number of different transactions to where we've financed 30 transactions across 7 states. Given the scarcity, we can often negotiate some sort of additional upside. So at maturity, not only are we getting our principal back, but we have the potential to earn something in excess of that. And to that point, we financed 5 dispensaries in the state of Ohio that we had a profits interest. And that profits interest, should the property sell, would generate additional income. And by the way, this is the reason that you saw those bumps in the monthly income where we were at 15, 16, and 7, close to 17%. Because 3 of those properties sold in 2024, which netted the fund an IRR between 31.5% and 65%. And again, because we're a REIT, we're simply taking that additional income and passing that along to our investors in the form of a higher income. Our deal pipeline today continues to be robust, and this is critical because we need deals to evaluate. And because of that scarcity of capital, there's no shortage of deals. And I would say, in fact, we're more busy today than we've ever been since we launched the fund, with more deals and bigger backlogs. And that allows us to be extremely selective. We're only going to choose the lowest risk deals to put into the portfolio. And over the next 45 days, I expect that we'll close more than 20 million of deals over a couple of different states. And to that point, I just wanted to show a few of the deals. The top right is the one that we just funded. Gosh, it's been about 3 weeks ago now. It was a deal for a $12 million deal for Verano Holdings. Verano is the 5th largest multi-state operator. Combined, there were 2 properties, one in Arizona, one in Nevada, with anywhere between 41 to 50,000 square feet. With this particular loan, it's a little lower on the interest rate side than we would have generally done, but the borrower has an enormous balance sheet, and it's one of the lower risk deals that we have in the portfolio. Some of the others that you'll see, there's a deal on the bottom right, which is a Connecticut deal. It's a $6 million loan. This is one that, knock on wood, it should close by the end of April. So we'll have another deal to talk about on the next webinar. And then we have 2 other additional properties that I'm showing on the left-hand side. So these are the ones that are the most close or most certain that will close. But again, We're in no rush to put money out. We are looking for quality deals. And sometimes those deals take 3 weeks or maybe even a month or two to close, but we're teed up and ready to close these deals. And so how do we generally get paid off for our loans? It's really in one of four ways. And I'll say there, I put four here. Some are higher probability. And the first is the borrower sells the building and we get paid off in the transaction. And that's probably the most prevalent. The second is the borrower has 2 or 3 or 4 years of additional financials and they go to another borrower that's willing to refinance us out. The third, and probably lower on the probability side, is the borrower generates enough free cash flow to pay us off out of operations, our funds from operations. And the last one is the borrower receives some sort of an equity transaction. And in that transaction, the debt gets repaid. And so there's 4 general ways that we get paid off. And then I wanted you to meet the team from MJ REIT that are really focused on managing the portfolio on a day-to-day basis. And I'm on the left-hand side, my partner, Gopa Dobson, our Chief Revenue Officer next to me. And then we have 3 individuals that I'm showing from Rainbow Realty Group, Kyle Schenfeld, Matt Gould, and Ben Bolanos, all focused on diligencing deals in the marketplace, while Gopa and I are focused on managing and running the fund so that we have a fantastic relationship between Rainbow and MJ REIT. So they've been fantastic partners. And then what makes us unique? I try to take everything that we just spoke about and boil it down to really 3 main points. The first is cannabis is a unique area, hands down. It's a unique area and every state has its own program with its own rules and regulations. So you need to know the space. It's not something that you can do on the side. You need to focus your attention. And as an institutional real estate lender, we focus exclusively on financing commercial real estate within the cannabis sector. Second is that we've done this before. And actually, I need to update this slide with exposure today to 27 properties across 7 states. And every one of those deals needs to be vetted and approved by the 7-member investment committee that has over 200 years of experience. And lastly, and going back to the slide where I showed the $2 million versus the $8 million valuation, is that we dislike downside risk. And risk is apparent in everything we do. Don't get me wrong. But what we tend to do and why we've been successful is that we've mitigated that cannabis risk. And so what I like to say is MJ REIT really allows our investors to be compensated for the risk associated with cannabis without actually taking that risk, because we're not financing that property with the cannabis valuation, but rather using an alternative use valuation, assuming that the cannabis tenant needs to be replaced with a non-cannabis tenant. So why allocate to us? It should be obvious, the double-digit annualized monthly income to help diversify the portfolio, maybe dampen the volatility in your portfolio. When you think about the last month in the public equities or public debt market, certainly reducing volatility of the portfolio may be attractive to you at this point. And then for the enhanced tax distributions, given that we are taxed as a REIT and you're only paying tax on 80% of the distribution that we provide. So all of these are different ways. And what I've generally seen is investors come to us to increase their monthly income or to continue to diversify their real estate holdings. They have exposure to other areas within the real estate market, but they don't have exposure to this unique asset, and they tend to allocate it to us specifically for that. Governance is a critical part of what we do. It's very important to me personally. We do have an independent board of directors. I chair the board along with my partner at Rainbow Realty Group, Matt Gould. We have Michelle Gillespie, who, for her part, she's started a firm called RT Wealth, helping independent broker dealers on the diligence side and really understanding private assets. Matt Malone is over at Opto Investments. He's been in the industry for almost 20 years. Opto is a Joe Lonsdale company. So for those that know or have watched Joe on CNBC, and then Jeff Mylock, who is in the private equity space, all individuals that bring great guidance to us and to help protect our investors. And then lastly, just from a summary, why allocate? We believe that given the institutional approach with a timely opportunity, and this is not an opportunity that's going to be around for 30 years, this excess income that we're earning off of the loans and mortgages that we underwrite will eventually normalize. And instead of lending at 14 or 15%, we'll need to lend like the 8, 9, 10% range. But also keep in mind, we have 0 leverage in the portfolio. So all of the numbers that I showed earlier are with 0 leverage. And it's an opportunity that it's not a closed-end fund where you have capital calls. So you allocate and you create your own maturity schedule. We've had a stable net asset value from a tax reporting standpoint, super simple, a 1099 div, no lengthy lockup. And lastly, we have a low minimum investment. When I created MJ REIT, I wanted it to be accessible to as many investors as possible and not just to the ultra wealthy. So I purposely set the minimum low so we can provide exposure and benefit to investors across the board. And so with that, those are the formal prepared remarks. Let me take a quick look into the Q&A. Okay, it looks like John has a question specifically on the place that you can hold MJ REIT and whether or not you can hold it in a retirement account. And good question. So we are available on a number of self-directed IRA platforms. If this is something of interest, please let us know. We're able to get you some information and allow you to select amongst a group of self-directed IRAs that you could allocate to. The next question is on the distributions and reinvestment. Looks like the question is centered on can you reinvest your distributions into additional shares? And good question. We do have a dividend reinvestment program. The great thing with the program overall is that if you do select to enroll in the dividend reinvestment program, you reinvest your distributions at a 1% discount. So that means you're coming in at 99% of net asset value. Said differently, you're getting a 1% bump in total return or valuation on your portfolio. In the fund itself, we have about almost 75% of our investors are participating in the dividend reinvestment program simply because they don't need the cash and they're looking to take advantage of some additional return. All right, it looks like that's all the questions. So we are good today. And in closing, I guess I want to say a couple of things. First, there's a big weekend coming up. Hopefully everybody has a great long weekend. And then secondly, hopefully this was insightful, good information, and we're always around for questions. And we really do pride ourselves on communication. So if you have any questions whatsoever about what we covered today, please don't hesitate to reach out to me directly or my partner, Gopa Dobson, and we're happy to jump on the phone. But that aside, thank you again sincerely for your time today, and we look forward to answering any additional questions that you may have. Thank you and have a great weekend.